The S&P 500 is sitting on a critical level. The NASDAQ remains resilient. The VIX continues to implode while the dollar breaks out, causing confusion. Apple breaks a critical level. Tesla remains wedged in. We'll show you how. NVDA remains resilient, but there are some cracks we should go over. The energy sector is breaking out. Why financials continue to struggle, adding even more confusion. We'll explain why the SOXX is consolidating and why communication services look like they're ready to break out. What the last hour of trading is telling us and why it looks like we're getting ready for a turn. What retail investors are doing in the option market and why we must pay attention to it. We have a ton to go over. Let's get to it. Hey guys, welcome back. We have a lot to go over. We're going to start with the basics. If we look at the futures market, see this little move coming off of it. Know that they reset futures. So what we're going to do is we're just going to focus on the SPY. Now, the reason for this is just because we have to let everything kind of catch up. But let's just take a look at the SPY here and we can kind of see the 55. And we're going to start today with this and just explain very clearly that you're having a tough time getting over that 55. And for those that are new, I use a 55. You should use what you're comfortable with. But you can see right here in these little lines right here that you're having a heck of a time. I do not like when you do this. So in other words, once you break a level, you have 5 days, then you're not there. 1, 2, 3, 4, 5 that you can get back over that level and you didn't there. Then 1, 2, 3, you're trying again, then you're over. 1, 2, 3, 4, 5, you really didn't clear it, and then there you are. So you're in some kind of battleground here. Now, the reason I'm starting here is a couple things that, in my opinion, they're misnomers, and we're going to go through that. But see how you're trying to hold in here, and then you really didn't, and people are going to say, all right, it's a light week. And maybe it is a light week, and we're going to drill into this. The biggest bone of contention I have with what I'm hearing right now is that it's very clearly, very obvious that we have a head and shoulders. And I'm just going to be honest, I don't know that. Now, people will say, well, can't you see your left shoulder, right? Can't you see the left shoulder, head, right shoulder? I mean, you have to be able to see it. I see that we have the possibility of that. What I would suggest is that you don't tie yourself to one thesis. That you take a look at actually what's happening here. And it's very possible that we're just basing. It's very possible that things are not as bad as we think they are. So when we start drilling into this, what I'm starting to see is I'm starting to see levels respected. I'm not so much seeing an area where we're definitely going to break down. What we could very well just be seeing is some consolidation after a very large move from March. Remember, in March, if you want to just get really super technical about this, we had the same thing. You had your left shoulder, you had your head and your right shoulder, and everybody was absolutely convinced that, oh, we're definitely going to run. We're definitely going to break down because now the banking, we're not going to be able to bank anymore and regional banks are going to collapse. I mean, everybody remembers this, right? This was the perfect time to do what? To buy. And so here we are with a very similar pattern we had before, and up here this time it's different. So I would just be really careful of that. We're just going to pop these lines in so you can see what I'm talking about and how you had support and resistance lines very similar to down here. I'll tell you when you know that that's really poorly drawn, isn't it? So I'm going to tell you that when you're down here, yeah, it does feel that way, but you need to actually crack. And we didn't do that. So again, what I have is the possibility of a head and shoulders, no different than I had here. This one was actually bigger and actually had a catalyst. I get that we are saying that we have some catalysts up here, but I really want to hammer this home. Stop telling the market what it's going to do and just trade what actually happens. None of us know what's really going to happen. We don't really have a clue. We're analyzing data constantly to make decisions. And that's the one thing that you should focus on, being able to analyze data, not predict. Nobody can predict. You might be once or twice, and that's probably the worst thing that could happen to you. Learning how to analyze what's happening and then looking at past sides of that and then trying to make a decision based upon that is probably a better way to go. So for now, the way that I look at the world is this. At best, you are doing what? You're basing. At best. At worst, you're forming a head and shoulders. If you go on that premise, that opens the door up and you're not tying as I refer to it, you're not really tying your ego to anything. But if you look at how that's set up here, you don't want to tie your ego to it. You don't want to say, oh, this is definitely the top. I don't know that. I don't know how somebody knows that. I've watched a bunch of people call it. I have no idea what happens. There could be a whole different movement that we see. For the same people that are calling the top, I want to be real clear about something. They certainly didn't call this. They certainly didn't call the bottom, did they? They certainly didn't call the regional banking crisis bottom, did they? but they're going today, now we know where the top is. It's hubris, and you really have to watch that with your trading. So what I would suggest is that you come up with a list of probabilities. This is what investment banks do, and this is why I'm spending a lot of time on it. So what investment banks will do is they'll assign probabilities, and you as a trader should be doing the same exact thing. What is the probability that this is a head and shoulders? For me looking at it, I would say that, okay, maybe there's a 50% chance this is a head and shoulders. I'm actually not leaning that way, but let's just say that I think it's 50. All right, and then I think there's a 50% chance that this is trading around and it's just going to form a base. Well, all right, so now do I really have a bias? No, I've assigned probabilities, and then as the data comes in, just like every investment bank, like Goldman, JP Morgan, they assign probabilities. Did you see what Goldman is doing with their recession? Whether or not you agree that there's going to be a recession or not, they're constantly lowering the probability of that, and that affects their trading and how they increase their exposure or decrease their exposure. I hope that's helpful. Please comment below if it is, but I see a lot of that where people are just saying, oh, well, it's very clear. To me, looking at the SPY, which we're using today, which is a little different than when we use ES, but based upon them rolling the options, I just think it's cleaner. So you start looking at these levels, I don't really see how you could be looking at this and saying, well, this long-term downtrend, it's clearly broken. I mean, you're not even there until 431 that it would break. You could make this argument in here, and that's a valid argument, just so we're clear. You have a minor trend here, not the major one, but you have a minor trend here from March. You broke it, and you're not able to get above it, and you're wedged in here. And that is happening. So I'm not saying that there's not clear signs that there's issues out there. I'm having a hard time understanding where the money's going, because you start looking at names like XLK and we're back to all-time highs. Now, as everybody knows, I love control bars. This bar has been in control ever since you had this gravestone right here on a weekly. And I do see this, and I think we should point it out. There's a gravestone and there's a gravestone, and they both possibly are marking highs. Is that a possibility? Yeah, that is. It is a possibility. What do I assign to that possibility? I don't know. I would say less than 33% if you want to get me to give you a percentage. When will I be convinced that it's probably greater than 50%? When I break 163.36. When I break 163.36, you might want to remember that level on the XLK. For now, all I know is that, and remember, 44% of XLK is Microsoft and also Apple. And we'll get into names in a little bit here, but there's some things I really want to cover with what's going on in the last hour of trading. If you've been following us for a while, that's definitely an indicator that we pay attention to. But when you start looking at the other sectors, let's get rid of that. And when you start looking at the other sectors, yeah, you're having issues. So I like looking at control bars because it tells me what's going on. And people say, well, what's a control bar? It's where the trend changes. When does the trend change? So for example, and this is, again, I'm a pattern trader, just so you understand when I'm trading. I look at that bar and that broke this rising pendant, right? This bull rising pendant, that broke when that bar broke. Have we been able to break down? No, you have not been able to break the low of that. Have you been able to get above it? No. This bar is in control of the SOXX, period. It's not even debatable. So if we want to debate it, we can. I would assign a probability of over 80% that bar is in control. Very similar to what? That same exact level that happened back here. So I have to go back and I have to look at this stuff and say, okay, well, what's happening? And then look at that. Okay, so this bar was in control. You were never really able to get above it. Got above it, but you never had follow through, meaning a follow through higher high with a close. You never had that. Never happened. You just got Wick City. So now we have this bar. We know back here that this was in control. We know that the SOXX ended its rally the same way that it ended here. So could we consider this a level of interest? Yeah. And the fact that we can't get above 500, yeah, this is an issue, and this is definitely something that I'm paying attention to. And we're seeing some rotation into different sectors. For example, instead of the SOXX leading, what I'm starting to see is XLC leading, and I'm going to walk through Meta later in this video, and I'm going to show a live day trade so that you can kind of understand what I saw on Friday, and then you can learn from it. I'll be doing that more towards the end. But if you look at XLC and you look at that control bar, well, we're staying above our point on our control bar on the major one here when this broke down. I mean, you can all see that H right here. And this is Meta, Google, Netflix. Okay, very different names than the semiconductor names, which are having a really tough time and struggling. Here's a major center, and we're staying above it. Now, we can all see this, but we're just going to point it out again anyway, just so we can go from there. Let me just drop that in right there. There you go. Thanks for working with me. And what we're going to see here is we're just going to see the inverse head and shoulders. That's right there, right? And then here's your neckline. Now, people recognize this pattern. I call them devil horns. This one should be red. And then you're flipping, right? So what's that? That's a control bar, right? Tries to get up, over, pulls back. Should have made a lower low. If you made a lower low here, then this could have been considered a peak. And then this bar still would have been a control. Instead, resistance is turning into what? Looks to me like it's turning into support. When did it turn into support? Pretty much here. I mean, you flipped over here, and then you tested here, and then you flipped back above it. A higher high is all you need to confirm that this is major support now. If that doesn't happen, what would bother me with XLC, and I'm trying to give you levels, guys, on this stuff that I think is pertinent, is I would look there and just if you break 64, you might be at a top again, and this bar might still be something that we have to deal with. But I'd be looking at these names, and we'll get into that at the end. I would be focusing on the XLC names. I think they look great. You start looking at REITs, we're still in this kill zone on REITs. I mean, nothing's changed here. You're still sitting here. This one is bothering me a little bit when I start looking at XLF. The fact that on the weekly, we just can't get above these levels and we just constantly are struggling. That's an issue. And it seems to me that, again, as I talk about, control bars, and what is a control bar? It's just exactly a level where a person or people have decided they're getting out, and maybe they didn't get fully out and they're still there and they're still getting out at that level. Meaning this is a level where they think that, believe it or not, people do use fundamental analysis to make decisions, where you're looking at a level where they are saying, okay, that is enough. That is a level that I want to get out of. And why do I want to get out there? Because I think financials are fully valued there. So I'm going to sell financials at that level. And that will work until it doesn't, right? Someone will either the sellers will give because they'll be exhausted, or the buyers will run out of money. And then that level will change one way or another, either by rolling down, right? I mean, that's what's going to happen. You're either going to what? You're either going to roll down from that level, break there and go lower, or eventually the sellers dry up. But someone's looking at that, and it might not even be a technical reason for that. It could be a fundamental reason. If everybody remembers the stool and how we look at the world, or how I look at the world through the stool, it's really simple. Macro, fundamental, and technical. And sometimes when you lean on that stool, you're leaning more on macro, you're leaning more on fundamental, and you're leaning more on technical. Right now, what I'm getting at, let's clean that off. What I'm getting at is when you're getting here on financials, somebody is just saying, yeah, that's fully valued for me, and I'm out. And then you look at the regionals, same thing, trying to get above the close, the close on the weekly on the regionals, and we're just not able to. Now we're going to talk about the dollar here in a moment, but before we even go down that little rabbit hole, we're going to talk about the Qs here and clean this up. And I just want to point some things out. Number one, this was a level of contention. We got over it, tested it, ran. So are we going to call the high on this again? I don't know. You're smarter than me if you know where the high is. I'm just going to tell you that right now. It's not something I would do. So what I would suggest is looking at these levels and then seeing how we're doing. And to me, right now, what I would be saying is, okay, this is definitely something that I need to pay attention to. This is an area that I need to pay attention to. When are we busted here? You're not busted to here. All right, so what we might want to do with the Qs, because to me, the Qs are leading over the S&P, which is kind of fascinating if you think about it, considering how energy is breaking out. I mean, energy is breaking out. That's really, it's very clear. People in the room are doing absolutely exceptional with it. And I've got some of them, but I kind of sat on my hands with it, because if I chase value names like energy, personally, I don't do well. The single largest holding I have right now, and I can do more of these at the end, it's going to be this gush position, and I'm just doing this because it's levered, and I'm doing quite well with it. But there's some names out there that are running SLBs when I have a position in. I'm not really getting the love there that you're seeing in the PSX. That you're seeing in the Chevron, these kinds of names. Why? The gas stations are really going to benefit here a lot. There's something called a crack spread. I might get into it a little bit later. Not in this video, we're not going to have time. But even like Casey's, like these gas stations, they're all setting up for big moves. We'll get into that in a minute. But what I would focus on with the Qs are a couple things. Number one, I would start looking at weekly charts here and trying to figure out what's happening. But if I clean off all my levels and look, we're still above the 12, the 22, and the 55 on the weekly, and we're zooming in on here. But the MACD did cross, and it's not getting better. It's actually getting a little worse. So we do need to be aware of that. Now, the RSI for me is undercut back to 70, which I don't like, and we're starting to pop out again. I'd rather get over 70 again, because we can stay there for a very long period of time. You can stay there for months. months you can stay above it. We've done this in the past. It doesn't have to have the Fed injection of capital to do that. That's definitely something that we want. We want to see this kind of get above there, and that's really where you can start seeing a lot of buying pressure come in. And that is a possibility here. But one thing I monitor very closely when it comes to the Qs, NASDAQ, is the rate of change. And we can see something here. We can see how we held right here. We can see the zero right here. And I'm sure you see that right there, how we didn't break the zero line, how when we broke the zero line, how that affected the trading. I'm not going to walk through this in great detail. I've done it in a couple other videos. What I will say is that when you're below the zero line here and you start marking it up, it starts giving you very clear indications that you're going to underperform. If we start rolling here while we're still up here and we get under that zero line and break that level, that's not ideal for us as far as traders that are being bullish. So I don't really have an assessment on that on a probability scale. What I would tell you to do is watch that 355 area. We'll be covering this. And I think that one of the key things to look at is what the major players are doing and what they're looking at. So really what they're studying a lot of is they're really looking at the dollar. Now let's flip through all this. And I'm looking at the dollar, and this is really something that is I won't say that it's a major concern, but it's a concern. So there's the 12 in orange. We're going to get rid of that. We're going to get rid of the 22, and we're just going to talk about these particular levels for a moment. And really what I want to focus on here, let me do it that way, is this death cross, and then I'm setting up a golden cross. Whether I want to or not, this is what I keep saying, is I don't really want to just have my thesis and saying I'm right. I thought we would not break this. I thought that this level would hold, and that would be it, and that we would just see another rejection here, and that the death cross would hold. Well, with what Japan did, and again, we've gone over this before, that marked the dollar rally. We've done nothing but rally on the dollar since the Japanese news and what they're doing with their bond market. This is leading me to believe that we have the potential for that golden cross. Now, you have done them before and then gone sideways, but if you look at these numbers over here, I just want to show you this, and you start going back about a week and you're seeing that you're about 70 cents apart if you look right at these numbers, and then you start moving them, well, you're now down to 50 cents on these numbers. They're getting closer. Now you're about at what, 40 cents? Okay, so let's say you're losing 10 cents a day. Well, next week you're going to have a golden cross, or the week after you're going to have a golden cross. If we just stay here, if we go higher, that golden cross is going to go even higher. This is something to watch, because this would be a massive change in trend. This can lead to pressure on the equity markets. What are the chances of us doing it? I don't know. To me right now, it looks pretty darn good that the dollar is going higher. And that's definitely something that we have to watch, and it's definitely something that we have to pay attention to. Now, this is your death cross. Go look at the market. Go look at the equity markets and how they acted when you had a death cross on the dollar. All right, when you had a death cross on the dollar, that was in January 2023. The market absolutely ripped since then. Okay, here's July, September of 2021. What did the market do when we got a golden cross on the dollar? The market absolutely plummeted from there. So what could possibly happen here? We could have some selling pressure on the market if we get a golden cross. And I do think that if we take a look at the data of the last hour and really look under the hood of what the market's doing, it can give us a better indication. Now, one of the indicators that we use is called last hour. And we've been laying off showing this for some time because we really haven't had a real reason to. What we're going to calculate, we're going to walk through the calculation. I just want to show you where we've peaked and then how long it took to get a peak based upon that, so you can understand what I'm showing you and what it actually is calculating, and then how to utilize it. You can see that you're starting to stall here, and you can see that this is exactly where we stalled before. But let's drill into this so that you can see what exactly this is for those that are not familiar with it. So this is an indicator that's actually created by a company. They call themselves Sundial, but it's actually Sediment Trader. And you can see that in a moment. You can actually see it right down here. So it's a paid service. I've spoken to them and then I'm allowed to show these. So I find these extremely helpful because they calculate a lot of data that other people don't look at. So in my opinion, it gives you an edge. I have no affiliation with them, but I think it's worth going over. So what I like to do with everybody is I want people to understand what we're looking at. So if you understand what we're looking at, you can then figure out if it's beneficial to you. So what they're talking about is the last hour indicator is a cumulative advanced decline line. Okay, so cumulative is the key word. Last hour tells you what it's doing. Obviously, the last hour of trading of the SPY ETF. So it is focused on the last hour of trading of the SPY ETF. If the last hour of trading is up, a value of 1 is added to the advanced decline cumulative count. If it's down, they subtract 1, right? So in other words, if you go up, +1. If you go down, -1, right? Up, +1, minus, down 1. Simple enough. So now just take a look at it and look for instances when the account deviates above or below the moving average by users' defined threshold to signal a trend change. Once a trend change occurs, the model buys or sells the SPY ETF when the ETF is favorable or unfavorable. Now, number one, you can use it for that. So what I put in this last hour is a 200 period moving average. It's exactly what you think it is. And we're going to chart the line. What we're going to look for is slope. Slope is more important than position, but obviously we want to know if we're above or beyond the line. I think it's very important to note that we cracked back here on the 200, rallied, and nobody thought that this was going to happen or had legs. And then we made what? A lower low, but look what happened here. You made a higher low here. I'm going to get into why this is important to understand and why that divergence is important. Then you had a period where you went sideways. That's going to become very relevant in a moment here. And then what happened? Rallied up and then broke down. Well, the peak, and our peak, if you take a look at that, is actually out much further. In other words, if you look at this peak and then when we actually peaked on the market, it's very different. What we can say is that this cross right here, and this is pretty interesting, that cross where we broke the 200 is July 27th, 28th, right in that area, which is exactly the top of the market. So when I did my analysis, I just thought that was an interesting statistic to bring up. It's not a be-all, end-all, but I do find it kind of interesting that this broke the 200 the day the market peaked. Now, did you have the same kind of system here? Not really. Did you have something back here when it cracked? Not really. If you obeyed it from that particular standpoint, you had this. But as we're aware of this particular period in time, we all know what the real issue was. The real issue is we all thought we were smarter than we were, and we had zero interest rates and $1.7 trillion behind us. So we know what the issue is there, and we know why everything was so skewed. Now, you have this entire cup going here, and you can kind of see behind how you have a cup right here. See how this cup is further back. In other words, if you look for this cup is further back than where this cup starts. So this is telling you that it's more than less likely a leading indicator. What this does, the market's going to do. To some extent, it's not exact correlation, but I think it's worth noting. If you're not buying the SPY and they're cumulative selling the SPY on the last hour of the day, seems like something you want to know since institutions move at the last hour of the day. SPY is combined to 500 stocks. You guys know this stuff. So if we look at what happened here, we look at this break, now we can start drilling into it because we understand this, but this isn't how we're going to use it. We're going to go down to 3. So now you're at a 3-year chart, and we're going to notice a couple things when we start looking at the 3-year. Number one, we're going to notice this little break here, and then we have this break here. So now people are going to say, well, that looks like a lagging indicator. Maybe, but if you go back to these levels, you can see where we hit lows, and then as we were hitting lows, what was happening? We weren't there, so we were making higher lows, and then we're making lower lows on the chart, and we know what happened right here. The CPI peaked. All right. So then we just kind of keep going forward, and this is what I mean. It's not an exact correlation. You break, the market kept going up. So you have to take it with a grain of salt. It can't be a be-all, end-all. I mean, when you look at the data and how they calculate it, one of the very first things they say is, by the way, this is a very long-term calculation that you're looking at. So look at the 1 year. Let's clean that off. Look at the 1 year, which we just put here. You can see your little break here. And if you use that as a buy, you didn't do very well. Again, these are things that we have to look at. And we have to look at this peak and say, well, we would have missed all of this. So are we going to catch up or not? I don't know the answer to that. This is what I found fascinating. If you go year to date, you get a very different picture on the market. In other words, what the year to date will do is we drill into the details is, well, this will tell you that you peaked in May, and then this comes later. So that tells you that you are what? About May, June, July, we'll call it, because you didn't really get to August before it happened, right? So we'll call it May, June, July. So this is telling you right now you're about 90 days behind, let's call it. If you took a look at this and then you see where the peak is there versus the peak is here, right? And we know it's not 100% correlation, but it's worth noting because again, if you're selling the SPY and you're selling the S&P, that might be something that we want to know if institutions are dumping stocks the last hour of the day. So we all know retail does not wait to the last hour of the day to dump. So if we know this and we look at year to date, now we can drill into this even more. Now we can look at this in 6 months. And now if you look at 6 months, you see this huge jaw-like spread. Well, does that mean anything? I'm not sure that it does, but I think this does. So what we're noticing is a start of a divergence. And let me explain what I mean by that. So we have this enormous drop in the last hour here, and we have this slight drop in the S&P during the same period of time. Again, we just talked about this. Here's July 31st. Here's the 24th, roughly 27th, 28th. Look when the market peaked. Look when we broke the 200-day. I mean, it's kind of crazy if you think about it, how accurate that was when we broke here for the high of the market. But what's really interesting to me is you can still see, let's draw this as a line because I want this to be clear. You could see how you're declining here. And then people would say, well, you're still declining here. Are you? Because to me, it looks like we're stopping. To me, it looks like all of a sudden, if we look at these peaks and we zoomed in on this, all of a sudden, we're not hitting lower lows anymore. So what does that mean? Well, that might mean we're hitting some kind of bottom level in here. And if we're hitting some kind of bottom level, and let's just say that this is 2-3 months out, well, that puts you in November, and we're starting the base. So what we're going to start doing again, because we haven't been looking at this for months, we're going to start charting this again, and we're going to start seeing how this plays out. But this was a data point that I thought was interesting. One, for you to understand what I'm looking at. Two, how it picked this high, which is just interesting. And then three, they're obviously not just dumping at the end of every single day, because if you take a look at August 18th, and this gets fascinating. But if you look at August 18th and you remember that that's when we had the speech, from August 18th, you really are not trending down that much. As a matter of fact, if you just drew this line from that peak and came across, and I know it's a thick line, but you're really still in that area. And all you're really doing is been hitting what? Lower highs. Well, you're hitting lower highs and you're getting wedged in here. So to me, that might mean that we're looking for some kind of bounce, and that could create some kind of movement later where we see a kind of upward trajectory. Robo put call ratio. The other day, one of the things we looked at was the put call ratio, and we looked at the deleveraging. I'm not going to go over that again. What this is going to focus on is retail only, buys only. And I'm going to show you how we're going to calculate this, or how it is calculated. Again, this is Sentiment Trader. One of the things I try to get everybody to focus on is what they should be calculating. In other words, do you have any idea what you're even looking at when you're looking at these charts? So the one thing that Sentiment Trader does a good job of, and I have no affiliation with them whatsoever, tells you the time frame, how often they update this weekly, where they get their data from, OCC. But Robo, retail only, buy to open. This is only opening positions, and it's only retail. What is retail doing with options right now? This ratio focuses on small traders. That's what we're focused on, to get a better feel for what they are trying to do. When looking at put call information, it's most helpful to see the volume is going into opening transactions or closing transactions. I agree. It is easy. It will tell us how aggressive traders are being or betting on the market move. Especially very small traders buying options to open is more telling than them selling to open. That's very true. So you want to know what they're actually buying, because that tells you which way the bet is going. Meanwhile, when people are saying, look at the sweep or look at this, sometimes that can work and it can be really good data. Other times you don't know if they're buying to open, selling to open. You don't know their full position. This shows you only buy to open, and it's only retail. So it's very specific, and it does have a value, and I'll show you in a moment. But what they're trying to do is just say they're trying to hedge, but doesn't matter. If he thinks the stock is going up, he's going to buy a put just for the thrill of it. If we isolate the trade of just those 10 contracts or less, so now we know it's guys that are doing 10 contracts or less, to further restrict it to buys and open transactions only, we can get a true picture of what retail traders, i.e. small brokerage firm customers, are doing. This ratio looks at transactions that are buy only, buy to open only. Very important, in under 10 contracts. Excellent read on the emotions of the smallest traders, and should be interpreted as what? Contrary. When the put-call ratio is high, that means small traders are buying many puts in relation to calls, and suggests they believe that stocks will decline. We'll take a look at how that's been working out for them. This is bullish for the market once it reaches an extreme. All right, you get it. So now that we know what we're looking at, we know that this is, if you are thinking that they're going to put a lot of puts on, and we know that this is if they're putting a lot of calls on. This would mean what? We would want to be pessimistic if this is going on, and we would want to be optimistic if this is going on. It's very hard to look at this data and take this into account And the reason for that is obviously because we had the Fed injecting about $1.7 trillion into the market. So all this data is absolutely skewed. What we want to look for are anomalies and when we're over certain levels. We recently just got back over this level, which tells us what? It tells us that they are buying the heck out of puts. So they are buying puts here, right at this level. Now, let's drill into this for a moment before we zoom out. And it's getting to threes. So just so we're clear, and we're going to talk about this 200-day moving average and how this is even more severe than we think it is. We're bottoming out right here, possibly bottoming out, I should say. And this is when the retail is the longest puts that they've been since, well, we're going to go back at least 3 months. This is a 3-month high on their put positions, and this is where we're at. When we topped, we can see that they were right around the lowest area that they've been. So we already can see that this is a contrarian indicator like they're saying. Zoom in and look at 6 months and it becomes even more glaring. We can see that high, we can see that low, and we can see the 200-day moving average. Now, I thought this was pretty interesting as a data point. So this is the 200-day moving average, and what we're seeing right now is we're seeing the break of that moving average. We're seeing our first rise over that moving average, and this is what happened, and that's where we're at. What's going to happen as retail starts to cover their puts? Well, the option market makers will start buying those positions back in, reducing the hedge, and then the market should lift. It depends on the volume and how much of a lift that will actually have. But I think it's pretty clear to see that when they do this, like they did this in March, when everyone thought every regional bank was going to zero, and they were over here, well, that put the bottom in. And then you look at this level here, and this is when they went crazy, and now here's where you are. Retail only, buy open. That's why this is so important, because it really hammers this point home. This is a pretty high correlation on what's going on as far as if you wanted to peak, if you wanted to look for a peak, or you wanted to see if you're at a peak, or if you wanted to look for a valley. I don't think it gets much clearer than something like this, quite frankly. You might disagree with me by looking at this. I'd like to hear it in the comments, but I mean, here they are. They're going crazy in January. They have to own tons and tons of puts. And we're going to show you how off kilter this was and what happened from January on. And all they kept doing on dips was just buying puts over and over again. Here they are again, buying puts. Look what's going on. That's a 1-year chart. Let's go take a look at a 3. Again, you really have to be very careful on how you look at this data because everything was skewed. We were fighting the Fed, which you don't do. I mean, you literally had the Fed in the open market buying equities on mortgage bonds. It was crazy when you really look back at it. But here we are again, and we're over. And then we have this historic period in time where we were over all the time. And that seems pretty common. Well, let me show you how uncommon that is before we get into the next thing in here that's pretty fascinating. If we looked at a 5-year history of what the amount of times that we're over this line, let's change the color of that, and let me just show you this. So here's 5 years. How common is it really for us to be over that? It's not very common. You have a pandemic. And if we put this here for a moment, maybe we do it this way so you can see. So we've had a pandemic, which you can obviously see right here. We can see how that played out. We had the Fed that was in here, and there's really, again, there's nothing that we can do about that, and that's going to skew this data. And then we have these little peaks here. And you can see how all these peaks are lined up perfectly with what's going on right here. So if we look at that, it's definitely something. We just put these little dots right there as well. So if you take a look at that, you can see how that's playing out. And now we're over here, and this is where we're at. So that's kind of interesting to me. Now, we understand that, and that's 5 years. But maybe it's that period of time. So let's go back and take a look at 10. And let's see how often we were in a situation like this over 10 years. So let's clean this off, and we'll start over. So here we are at 5, 6, 7. Okay, so now we have to go back to 15. So now here we are 10 years out. See the level right here. Take a look at these levels right in here and right in here. Peak, peak, low, low. And obviously you can see right in here as well. What are they doing? What's every single one of these doing? They're all doing one specific thing. They're all marking a low, period. It's irrefutable. It's a very high correlation. Now, 15 years. I thought this was absolutely fascinating because it's not that often that this happens. And why is that important? Because what we're always looking for as traders is we're looking for an edge. So we know that 10 years. So what we're going to do is just go back from here and take a look. How often does something like this happen? Not very often. Now, if we go back and just take a look, 20 years, how often does this happen? It didn't happen for 7, 8 years back here until we got up into this range. And then there was multiple years where it didn't happen again. And now we have these extreme readings over here where everybody's, especially retail, is being extremely bearish. Now, this is where it gets really kind of wonky. So what we have below down here is we're going to have a 200-day moving average. That's what's in green right here. And why that's important is if you take a look at this moving average tends to be around that 0.6 level. We got almost to a pessimistic level because of what happened down here. And so what you do is you get an equal and opposite reaction, right? See how you wrote down here? And then all of a sudden you're going to get something extreme up here, okay? For every action, there's a reaction, right? So you kind of get that. All right. So now this is where we are. And we flipped and we're over. But look at where you are on the 200 in relation to where you are and how extreme that reading is. All of this has been pretty extreme, but this is pretty extreme. And this is coming off that bear market. Now, to put this in context, take a look at this on a 10-year. And this is where, to me, that reading's even more extreme than some of these others. It's even more extreme possibly than things like this, where you're looking at the 200 and you're at a 0.6 versus where you're under a 0.6 and you're here. Then you look here and you're like, well, we're almost at 0.7 on the RSI, on the 200-day moving average, and then we're here. So what I'm getting at is if you start measuring this stuff off, and you're saying, well, from here to here, we are on the 200-day. Here, from here to here, this one's pretty extreme. I don't think we're that close. But then you come here and you're like, well, that's insane how far off we are for something that doesn't look that far. This obviously was the peak. Guess what that marked? So I think there's something to this. See this right here? And you can see how that played out in 15. And I think that's a really important distinction. You see it here, and you can see how that played out. Now, I just want to do this one, go back a little further on the 15, because, and why I want to do that is just so you can see these levels. If you click right here, and you see how high we are, you're nowhere near the same percentage that you are all the way back here, because the level of the 200-day moving average is so high. So not only on a relation are we over this level, which I think is significant, you're significantly over in relation to where the 200-day is on a historical basis. And if you go out 20, it's way over. You'd have to go to the great financial crisis to find anything even remotely close to it. So I think that's pretty significant. And I do think that this is a pretty bullish statement. Now, it doesn't mean you just reverse because you're over, but I'd be interested in the comments on what you think of this. I think it is very highly correlated, and I really like, very specifically, how they broke this out for us. I think they did a great job in breaking out just the way that we're supposed to look at the world here. I really think there's something to looking at only retail only orders under 10 that are buy only, and you can tell if they're buying puts or calls via the ratio. I think this has significance, and I think it's something right now that we should be monitoring. So now we have an understanding of where everybody's at as far as the retail players. We know where the last hour is, which is institutional players. We look at that. We looked at our indexes. Let's go through some names so we can kind of see what's going on here. And we're going to focus on the larger cap names to start. There's a couple smaller cap ones I will go over. If you kind of look at our setup here, you can see your level right in here, or you should be able to see this pretty clearly, that you have a support level coming straight across in here. The one thing I'd say about that is maybe it holds, maybe it doesn't. We just don't know. What I found interesting was the sell-off just happened to coincide with a very short trading week. This week is a huge week for manipulation, quite frankly. You have very light volume coming off. It's historically a very volatile week on light volume with no follow through to the downside or the upside, which is exactly kind of what we're seeing here. We're just kind of bouncing around on Apple. Now, am I crazy about Apple's close here? No, not at all. Right. I mean, you can make excuses all you want, but at the end of the day, the pattern is the pattern. Right? We can argue about it, but if we just kind of look at how we were able to get back over the open of that breakout bar, and then that was it, rejection closing at the low, it's not really what I want to see. We're going to have to see how this plays out on Monday, obviously, but I would watch Apple. As Apple goes is probably how XLK is going to go, and then XLK really has been one of the pins of the ES and of the SPY, so we're going to have to watch that. But that's a really clear rejection here of some key levels. So what we're going to do is just up for a moment, take out the 12, and then we're going to just remove the 55 for a minute and just look at the 22 and say, we couldn't even get above the 22. We hit it there, and that was the end of it. And as everybody knows, or if you don't, I use a 12, a 55, and a 200. You should use what you're comfortable with. I do get asked a lot why I use these levels. I've given some explanations for it, but it would actually be a whole video. My troubling issue here, number one, and it's very slight, and a lot of people are not even going to notice it. For me, position matters, slope matters more. Really does. Whether I'm up or down on the average, yeah, it's an issue, but I'm really interested in the slope of that average. So one thing that you'll note here is the 22.55 cross. Since then, you're not really getting above it, are you? And so these crosses all work the same. What I mean by that. So what I mean by that is if you have a cross here like you have here, let's make that an arrow. If you have a cross like you do here, the top and the higher number of the bar, or the higher number of the moving average, that becomes your resistance area. See how you're resisting in here? So you need these to cross back in order for that to change. It's a lagging indicator for sure. We just saw that on the dollar, but it's there, and it solidifies a change in trend for that particular time period, and we're just not there yet. All right, so we see this and we know what we're doing. We know we have a gravestone right here. Nobody wants to see a gravestone doji, obviously, not if they're long. So you kind of roll back and go, okay, well, what do we do? What do we do now with it? Well, this is what's really troubling to me. So I'm going to take out the 22 for a second, which we can see is rejection. And I want you just to do me a favor and focus on what's going on right here. See that number, 186.25? So what we're going to do is we're just going to show you something. So you can see how that number over time keeps going higher. 14, 12, 16, 23, 32, 43, 51, 35, 51, 35, 51, 35, goes down, 35, 25. Okay, I understand that it's a very slight movement. People will say, oh, it's very slight what you're talking about. Is it? Okay, because I see it as a movement. So, okay, let's say it's slight. Now let's take a step back for a moment and let's do it this way and click on here and hide. Okay, let's say that that's a slight movement. Now, let me show you this, and I don't want to go too far down the rabbit hole. Is there a reason while the 55 moving day average, someone has come out and said that's as high as the 55-day moving average is going to go? So as you have, and I'm not going to go down this rabbit hole too much, as you have double tops and double bottoms on stocks, you can have them on the moving averages. And you can see right here how that's starting to happen. That's a concern. So what we don't want to see on this moving average, so that you get it, I'm just going to do this quickly, is if you look at this number, we don't really want to start seeing closes below 186. That's really what we don't want to do. You could say that you're being too nuanced here. There's an argument to that. I don't really want to start seeing closes below 186 on Apple. That is not going to make me feel warm and fuzzy about the entire market, especially the S&P, since it's about 7% of the S&P. It's actually greater than that now, I think. So that's definitely something that I'm watching, and I'm using it as what? It's a guide. It's one data point. It's not the be-all, end-all. But you look at this and you look at that weekly, and you can't feel warm and fuzzy about that. Like you just can't look at that and go, oh, thank God it's coming down. And it's coming down at such a violent pace right ahead of iPhone. I mean, maybe the iPhone 15 is a disaster, and all they did was give you a new emoji that turns you into a giraffe. I have no idea. We'll find out together. I'm sure there's other sites that or on YouTube, I'm sure they're talking all about the 15. And if it's not a major blockbuster and they're just going to give you new earpods that you have to buy, it's probably going to be a problem. So I think we're going to have to really watch this closely. If you break this level and you start rolling here, you can absolutely get to this 200-week moving average. Well, that's not the 200-week. Hold on. Let me show you what a 200-week is. And I don't want the 22. I want the 22 in there, and I want the 55. You can actually absolutely get to this 55, the 160. If that breaks, I'd be surprised if you really start breaking down into this. I don't think you'll get to this at all. I do think you can get into the 160s. I do think that's a possibility, but this is the 55 week, not the 200 as I stated. Thank God for color coding. And then you can see right here 134 and how that could happen as well. So we look at that and we look at the XLK names because we want to understand what's going on. Well, someone tell Microsoft that they're supposed to be having a problem because for now they're holding. So, and you can see how we're holding right into that level. We're doing really the exact opposite. And one of the things that we're noticing here, or I'm noticing, I should say, is the cloud names don't look awful. Let me clean all this off. And it makes me wonder, are they going to be the leader? So you're rallying through. You tried to get through that 200 week. You failed. You bounced down. You got to that 22. You're held. You're back through the 12. Look at how these are widening. So in other words, are we going to see rotation? And that's kind of where I'm going with this. So when we looked at the NASDAQ, we looked at the ES earlier, and everyone's saying, not everybody, but a lot of people are saying, oh, it's definitely a head and shoulders. And I'm saying assign probabilities to it because you really don't know that, right? Unless you've been into the future. So, and if you can look here, these are widening. Well, if these are widening, what does that mean? Well, that means that people are buying cloud names. Okay, well, let's just go through the big guys. Right? Does Oracle look like we have a problem? Or does Oracle look like it's about to rip people's faces off? Because I've got 3 major upgrades on Oracle going into earnings that are saying 140, 150. That's interesting. We have Dell hitting all-time highs that sells to who? Dell sells to corporations. Well, they're exploding. How about IBM? How are they doing? Okay, well, they just hit an all-time high. So do we really have a market that's falling apart, or do we have a market that's rotating and consolidating? And I would argue that if you look at these names, that I think that we're more to me, that there is rotation and there are spots to make money. So I would not just throw out the, as they say, the baby with the bathwater. Maybe they still say that. I'm in my 40s. Let me know if they still say that. Put that in the comments. So, all right, here's your control bar. We were just talking about it. Let's clean this bad boy up and just look at this on the weekly. I mean, how can you not like that chart if you're looking at crowd? Forget everything else. Forget moving averages, price, everything. Just read price rather. Okay, low. Higher what? Low, higher low, has to figure out what it wants to be when it grows up, breaks out above the control bar. Give me a higher high close on this and you have a change in trend. Give me a higher high close on crowd and you have a change in trend. So you're going to look at these names, look at Snow. You're going to look at these names and say, well, you really can't look at that and say that it's doing anything. And I'm not a huge fan of the price point on this one. I'm going to say that off the rip. But I can't say that. That was a rejection. That's why I'm not including it. I can do a whole video on how I draw my trend lines. Comment below. I think that people are going to want that. And I'm trying to work in, and we're going to do it today, I'm going to work in an educational video directly into this on a meta day trade that we did on Friday, so you can see exactly how it goes down. I'm going to actually show, I edited the trade, because I trade live in that room. So I'm going to edit the clip so you can see what's going on there. You don't have to watch the full hour. But if you see what's happening here, do you really think you need to be out of that? I mean, do you not, there's something going on here, guys. That's all I'm saying. And I don't know what it is. I really don't. I don't know why we're moving the way that we are and why software is becoming the new thing. But I would be really careful sleeping on some of these names when you start looking at Snow and you start looking at Dell and what's going on. Intel and this breakout, and I'm going to just caveat disclosure, I have a very decent sized position in Intel. And if this becomes the next thing, well, that's going to be fairly interesting because they are very depressed from a company standpoint. Look at the weekly. Let's go out here and zoom in. And again, all I'm doing right now, is just looking at price with you. That's all we're doing. We're just analyzing what's happening and looking at support and resistance levels. And it's a good way to just kind of take a step back, sometimes just clear out the cobwebs and just see what's going on in the world. All right, well, that's interesting. So we broke above and then we made a higher high. Well, when was the last time we did that? Well, it looks to me like it's been about 52 weeks. So you have a 52-week high, and all we're doing is we now have a bottom. It's very clear where the bottom is on Intel. That's very clear. And then what did you do? Low, higher low. Higher low, higher low, breaks out. It's not rocket science, guys. Watch 40. Okay? I mean, that is a major level here. What would happen if you got above 40? Someone like myself might say you might want to watch the control bar and see that breakdown of that neckline and then see how it goes. This might be something that you might want to put on your radar, especially since I am not in the AI is a fraud camp. If we were talking about probabilities, I would assess about a 0% probability to that. There is one name here that I'm going to go over that I do think that people should start putting on their radar, which is going to be weird because it looks awful. But I found the comments that came out of investment banks very, very interesting. Anyway, here's NVIDIA. Does this look like it's going higher? I don't know. I don't have an answer to that right now. Here's what I do know looking at the weekly and just reading price. This is your control bar. You broke down. You undercut right here on that, okay? You broke down. You undercut right there. And what couldn't you do? You couldn't follow through. You rallied. Earnings, rallies. Everyone's upset because we're not at all-time highs. I mean, let it breathe. And then, oh no, we had a week where the stock actually went down. Surely that's the top. really? Again, you're smarter than me. So you're seeing this level and you're unable to break that control bar. Get below that control bar, and that would let me know that I'm probably in this 400 to 450, 452 range. What this is telling me is that 451, I'm still holding. Let me show you this and drill into this on the daily, because I find this kind of stuff kind of fascinating. When you start looking at where these levels are and you go rejection, 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 I said that way too many times there, and then you drop in your levels and then you realize it's the 22 that's there, right? This 22. Now, we closed below the 22 on Friday. I would not pretend that's not a big deal. I would, on a shorter time frame, that's a big deal to me. Riding the 50, that's a big deal to me. I break the doji here, I still have the 55, which has been major support, but I have not closed below the 22 on 1, 2, 3, 4, 5 major attempts to close below it, and I did on Friday. Now maybe we can blow it off and say it's option X or not. We can make excuses for things, right? Or we can actually look at what's happening and just say, you know what, we might want to watch this a little bit. Could this get toppy? It could. I mean, you start looking at some of this stuff, like SMH is 17% made of NVDA. The SOXX can't get back over 55 or 500. And you start looking at the cycles. Well, why is KLAC up here? Why is AMAT still up here, right? When they still are up in these levels, why is Lam Research where they are? Well, we still have to go through the cycle of the build out for what NVIDIA is doing. And now you have Intel and some of these other companies that are going to compete. So when you start looking at this, you want to pay attention to that. I look at these levels very carefully. Even something like Tesla, you know, I'm in a battleground here, guys. And this was one trade. I'm only going to walk through one trade today, but this is one where I had a real battle on Friday with this trade, and I'll walk you through parts of it. So this is where that 55 was, and it just kept tearing me apart up here. And I kept watching these wicks. I'm like, this thing's going to break. And eventually, yeah, it did. And I put it back on, and I did quite well with the ad, but I lost money on the first time. And don't let your thesis go away. Just remember that if it doesn't work once, don't change your thesis. It's like the worst thing you can do if it's still obeying. And this clearly obeyed. Here was your high tight flag. I couldn't even get 50% on the bar. Here's your control bar when it broke down. Couldn't close above it. I mean, when you start looking at this stuff, it starts becoming clearer, right? So you're seeing these actions here, and then eventually this just worked out. Everyone's saying now that China's going to go after Tesla. I don't know that. Again, people are smarter than me. But if you look at these levels, okay, I've got what I don't want here now. If you own Tesla, you have what you don't want. You have a sloping down 55. I have 1, 2, 3, 4, 5 tests of that 55, and I'm completely matumboed there. Is that something you want to buy? Look at how you're coming across here, and now you need to hold the 12 and 22. So you're boxed in here, guys. I mean, it's pretty clear that you're boxed in. And some of these other names, they look great and they're acting great. You look at AFRM, and this is something I was pointing out the other day, and this is something else I added to, but we've been talking about this stock for 2 weeks. I've got one red day. Like literally one red day. And now I got a dragonfly on the top of a chart. Look at this weekly. So it's not every stock that's going to come in because the indexes are coming in. Sometimes we might start seeing the story stocks. And if you've been around a while, you've been trading for years, that's how it used to be before we had zero interest rates. There would be actual stocks with earnings and stories, and you would get involved. The market has turned into one big trade based upon the dollar and everything else, and it's all moving in tandem. It wasn't always like that. Go back and look at Fed funds, and we've done this a million times. Go look at Fed funds in 2005 and what the rate was and how the market moved. We're acting exactly like that kind of movement now, just FYI. But anyway, you see AFRM? These things are breaking out. You look at Meta, and this is troubling to me as somebody that has I have a position in it. Swing, I did great with the day trade. We're gonna watch that day trade in a moment here. I want to show it to you live, and then I want to go through one more name that I think is really important. But I have an issue here, and it needs to be addressed. So let's get rid of the 22, let's get rid of the 12, and let's talk about this. I'm riding that 55 down. I'm having a real tough time closing above it. Now we can make excuses again that it's Friday, and there's some validity to that, but I'm still struggling here. So what we did on Friday was we had this trade, and it's a trade that I taught in the room. We do educational classes in there, and we bought this bar. It gave us a signal. We bought this bar, and then we just traded it up. And then when it cracked, that was it. We got out of the way of the day trade. That doesn't affect my swing trade. So we did very well in the day trade. I'm going to walk through it right now so you can just see what we did and go. Meta, that couldn't work today. When people realize what happened there, let's watch that bar. I think we could say that on the Meta bar, that maybe you could use that as news. The fact that people got shaken out yesterday. The line, it's this Meta. Yeah, that's probably the one that I'm going to use 300 as a stop. I'm going to use 300 as a stop. I'm in at 31, 301 and a quarter. It's going to cost me $1.25. If I hit this, I'll just blow it out. I can see people looking at that and realizing they shouldn't have sold. I just don't say it. There it goes. Boom. Come up $1. If you're just day trading it, if it's a day trade for you, just pull some money out. If it's not a day trade and you're trying to stay in it, stay in it. You won't let it go down to break, past break. Especially if it's a day trade. If you're trying to hang in there, hang in there. You're probably going to at least come back, right, to something like this. And then maybe you'll get through that. So let's watch right there and see what happens. So if it's a day trade, I would take some for sure right there. If it's not a day trade, stay with it. If it's a day trade, I would take some right here. So you should be able to see that. There's your level and there's where you stopped. Doesn't really get any cleaner than that. There we go. Who's the winner? We are. So what you do now is just let that bar form and then use that low of that bar as your stop. The stop on that whole trade is going to be 302.35, all from using that system that we talked about last Saturday to enter a trade. Why could we use it here? Because we had news yesterday. So it's going to trade off that news today. Again, that's your stop. I'd like the bar to form for that to be my stop, but that would be my stop. So if it hits that, boom. If it's a day trade, I'm out. If that makes sense. It's way too easy to make money right now. They're going to rug pull. That's where you broke down, isn't it? That's your next level right here. You say it right there. That's where you got to, and now you're rejecting. That might be it. Watch. And that's where the majority of this was actually, wasn't it, from yesterday? So those people might be getting out. So you should be taking stuff out, guys, when you're scaling out, right? Positive slippage. Again, you take that out, trade's busted on the rest of it, and day trade's over. The dream is dead. Wow, look at that game. Right to your, well, you know your levels, you know you're struggling. So again, if you're day trading, you're selling into this. You're pulling something out. And for the rest of it on the day trade, just use that. And when it hits, it hits. You should have done quite well up here, scaling out into it. And it gave you 2 other shots right here, right? And then when that breaks, and you can use the close. That's a pretty nasty bar right there, guys. This is going to start rolling this stuff. I think it's coming. Let's see. It's way too easy to make. So you're getting wedged in here. So you're selling into these, guys. I can't be any clearer, right? If you're day trading it, you're selling into that level. Up over $2 and change. If you did options off of it, great. If you didn't, you didn't, whatever. But that's what's going on. So that got us into this trade today, which got us this, whether you did options or stop breaking down. There we go. Boom. All right. So now you can also just trail the 9 there on Meta. Trade's working out perfectly. What a great trade. You keep pushing through this 304. If you're day trading, you got to be pulling something out because you're not following through. We're not following through. So if you're day trading, you're going to have to pull stuff out. It's an issue, guys. I'm not saying you're not going to break it. I'm just saying it's an issue. So far, you haven't had one close below the 9. We use that as a guide. Take a look at a 5. Yeah, I mean, I don't see anything there that you're going to break. Okay. There's your, I mean, that's pretty clear, guys. So if you're still in this trade, let's get rid of that level. That's no longer our stop. And our stop now's got to be here, right? You got to be using the low of that wick, which is the low of the flag that you're just trying to break out of, which is 302.65 is what I would be using as your stop now. Worst case scenario on the whole trade. You're still hitting it. We would do that right here. I might have to just watch for now. But I thought the volume. Once this bar forms here on Meta, what we're going to do is just use that low will be the stop next. And then you kind of go from there. Again, if it's a day trade right now, you're using 302.65. And then we're going to use the low of this bar. That's your breakout bar. And then if you crack that, that should be your stop. Really what you're waiting for now is just the next moment for it to close here, hopefully, and then give us that bar. And then that'll be it for the day trade, that little spot right there. And you're up like 2.25. If you did options, great. If you didn't, you didn't. Here, Meta 305. Yay. So now our stop on this is 303.65. So you're going to use this as your stop, and then you just kind of walk yourself up. Where would be our next real resistance points? Really right here, top of that. This is where you had. So why? Because you broke out, tested, and then you broke out on this bar. So this is your breakout bar. So that's going to be an area of contention. Up, down, up. Just like this is going to be next. This will be your next problem right here because that's when you broke. And you can see that you broke that area of contention here. So the top of that's going to be your next area of contention. I'm seeing a lot of that, guys. A lot of these flags this morning. Rips, and then you're just sitting up there. It might be a reversal there. Let's see. Yeah, you're getting kind of toppy in here. Again, if you're day trading, what you do is you scale out into these. You get positive slippage. At this point, I'm all scaled out. So the rest of what I have on a day trade would just be this. All right, so you have a bar right here, and I think it's going to happen. So right here, you should be out of this if it's a day trade right there. If you're a day trade, 304.6, you're out. Everything else, if it's not a day trade, you should be using this. If it's a day trade, you should be gone. If this was a day trade on Meta, congratulations, and you should be out of it, and you should have done exceptionally well. This is off the strategy that we taught when? last Saturday. So I hope that's helpful. Comment below if you like seeing that or not like seeing that. I think that's more helpful than me just pointing at a chart sometimes and saying, hey, this is what we did and aren't we smart? You can actually watch it play out and you can watch the methodology of how I think. The important part of that is how I even started this video with saying, hey, you need to learn how to analyze and assess probabilities of what's going to happen. And what we're doing the entire time is looking at points of contention on names and making decisions based upon that. Like over here, we were talking about, oh, there might be some consolidation over here. Okay, here's the control bar. And then, oh, we might want to watch the top of that control bar and see how we act. And then you can see how we broke through, unable to close, shooting star, set us up perfectly to get out. And you look at that versus being someone saying, oh, I only swing trade. Well, you only swing trade, you would have lost $8, right? You have to understand the market that you're in at the time. I could spend a lot of time on that trade, but there's a lot of learning lessons in there. But I hope that was helpful. Please comment below. And obviously I edited it out. You might have heard some of the humming in there. And if you do, I apologize. Sometimes I hum or put music in the back. I obviously couldn't put music in the back for this because YouTube would catch it. But if you look at this name, First Solar, I just want to point this name out as something that should be on your radar. It's on my radar. I'll tell you why. The fact that I had an analyst day and I had 3 analysts at very big firms, and I do look at this kind of stuff, come out and say, we're raising our estimates after analyst day, we're raising our margins, we're raising our target prices. Including Goldman, who, if you listen to these, you know I respect greatly. It doesn't mean they're always right, of course. You need to put this on your radar. I know this chart looks god-awful. I get it. You could say, well, you have a kind of a base here. I don't know that you do. I mean, I just see Wick City. It's on my radar. We're in with a very tight stop. And to me, this looks like it does have some potential. What got me was when we talk about this, and we do go through this, we talk about the stool, and we talk about the analysis of the stool and whether or not, you want to be involved. Sometimes you're leaning macro, fundamental, or technical. To me, this is leaning clearly on the fundamental side. But I do think that it's going to then start leaning technically as people are buying it. I think you're going to start seeing some accumulation. Just my opinion. That's it.